Hey investors, welcome back to Stoxpot, your go-to podcast to unpack what's happening around the world of business and economics. Today we are diving deep into a topic that's been on everyone's mind, India's equity market crisis. Over the last 5 months, benchmark indices like Nifty 50 have fallen by around 15%, marking the longest losing streak since 1996. Panic and uncertainty are gripping investors as billions of rupees vanish from the market. But what's causing this downfall? When will it stop? And most importantly, what lies ahead for the Indian equities? So stay tuned as we unpack the story behind it and explore what experts are saying about the future. Now let's get started with the bigger picture. The Nifty 50, India's premier equity index, has declined for 5 straight months until February 2025. And this is the longest losing streak in nearly 3 decades. In just 5 months, the market capitalization of listed companies has dropped by over 90 lakh crore. And that's a staggering amount of wealth wiped out. Why is this happening? Several factors are at play here. First, global economic cues have worsened. Countries worldwide are facing economic slowdowns, which affect how foreign investors view emerging markets like India. Second, earnings growth for Indian companies has slowed down as well. Companies are not making as much profits as they used to do, which makes investors even more nervous. Third, foreign institutional investors have been pulling out their money. Between October 2024 and February 2025, FIIs sold shares worth 2.12 lakh crore. Adding to the pain is the falling rupee. During this period, the rupee depreciated by around 4.4% against the dollar, reaching an all-time low of 87.97 on Feb 10, 2025. A weaker rupee makes import costlier and reduces the attractiveness of Indian markets for foreign investors. All these factors combined have created a perfect storm for Indian equities. Now looking at the impact on different sectors, not all sectors have been hit equally. Some have suffered more than others. For instance, the Nifty Media and Nifty Energy indices have crashed by 35% and 32% respectively in the past 5 months. These sectors are highly sensitive to global demand and input costs, which explains their sharp decline. Other sectors like real estate, automobiles, and FMCG have also seen significant losses with declines exceeding 20%. Even the banking and IT sectors, which are usually stable, have not been spared, with a drop of 9% and 11% respectively. What's interesting is that broader indices like Nifty Midcap 100 and Nifty Smallcap 250 have entered bear market zone. A bear market happens when an index falls by 20% or more from its recent peak. These indices have dipped by 20% and 25% respectively, reflecting the widespread nature of the downturn. Now looking at earnings growth, one of the key reasons behind the market slump is the slowdown in earnings growth. Data shows that the profit after tax growth of BSE 500 companies, excluding oil marketing companies, was just 8% in the quarter ended December 2024. Now compare this to 9% in the first half of the year and 21% in FY24, and now you can see the sharp decline in it. This slowdown is happening because the benefits of lower input prices, which boosted profits earlier, have faded now. At the same time, revenue growth remains weak. Most sectors except banking, financial services, and insurances are struggling. Experts believe that consensus estimates of even 14 to 16% PAT growth for FY26 and 27 might be too optimistic given the weak demand dynamics. And now let's talk about the million-dollar question: when will the market bottom out? Experts predict that the Nifty 50 may stabilize around 21,500 points. They expect a prolonged consolidation phase until foreign investors find Indian markets attractive again. Some opines that market will remain volatile in the near term, but could stabilize by December 2025. By then, the impact of government initiatives and a potentially normal monsoon season may start boosting consumer demand. In short, tariff war should cool down and earnings growth should improve to lift the sentiment back to normal. Now let's see what should investors do. While it's tempting to panic during such times, experts advise focusing on companies tied to domestic demand and import substitutes. These sectors are less affected by global uncertainties and currency fluctuations. And long-term investors should keep an eye on sectors like banking, diagnostics, and contract and development manufacturing organizations, which have shown resilience in earnings growth. Now looking ahead, next few months will be crucial for Indian equities. While the road to recovery may take time, there is hope. The GDP growth rate accelerated to 6.15% in Q3 of FY25, signaling some improvements in the economy. Government spending on infrastructure, which had slowed earlier, is picking up again. In conclusion, while the current situation is challenging, history has shown us that markets always reward patience and resilience. Whether you are an investor or just someone curious about the economy, staying informed is essential. And that brings us to the end of this episode. Thanks for tuning into Stoxpot. If you find this episode insightful, make sure you follow and share this with your friends. Until next time, it's me LEKSHMANmj signing off.